Hello, everybody, and welcome to today's session on navigating the rise in interest rates and declining property prices. We'll just give everybody a bit more time to jump in, and then we'll get stuck in because I'm sure a lot of you are really interested in the topic that we're covering today, particularly the way that the news has been over the last 14 days or so when it comes to the economy. Looks pretty sunny where you are, Mark. Melbourne's turning it on again.
That's an illusion. Melbourne's freezing.
It's your lighting. It's your very effective lighting.
I've got a window, next to me, which probably makes it look a lot nicer than it really is. I think if I turn my screen around, you'll be seeing icicles.
All right, guys, let's get stuck in. So, welcome everybody. As a lot of you know, I'm Josh Marsden. I'm one of the founders of the Active and Thriving program. So Active and Thriving is a workplace health and wellbeing program that uses behavior change theory to help people improve their mental, physical, and social wellbeing. And with me today, we've got Mark from Hey Coach and Marius from Loan Market. And as leaders and experts in financial wellbeing, we're really proud to have them here today because not only is it very topical, but Active and Thriving, we're actually moving towards adding financial wellbeing as our fourth pillar of wellbeing inside the platform as well. And Hey Coach are acting as our advisory for that. So before we go into the questions, Mark, it'd just be great for you to give a bit of background about yourself and Hey Coach.
Thanks, Josh. Hi, everybody. I'm Mark McLeod. I'm the founder of Hey Coach. So as Josh said, we're a financial wellbeing platform. We help people understand their financial position across all their assets, borrowings, and cash flow. And we help people make good, informed decisions around what they want to do next with their finances. And we do that through a combination of digital AI, but also connections to trusted experts when people need it most. My background, I've spent most of my career in financial services and equities, supporting banking, superannuation funds. And Hey Coach is really about making professional advice more accessible to everyday people without a huge price tag, upfront price tag attached to it. So thanks for inviting me, Josh, to this session.
Pleasure, Mark. And looking forward to digging more into the Hey Coach as well. And Marius, so Mark introduced us together. It'd be great to hear a bit more about your background and the great company that is Loan Market.
Yeah, thank you. And thanks for having me today. I'm a mortgage broker with Loan Market. I've been in the industry for 23 years. So I've been able to see a few cycles. And when the Reserve Bank puts up rates and the knee-jerk reactions that people generally have a response as a result of that. But my experience in the industry has always been with residential mortgages, purchasing, refinancing. We do a lot of, all of our clients range from people with PAYG customers to self-employed. And our main objective, having dealt with people for 23 years, a lot of people still existing clients from back when we first started. We do a lot of mortgage planning, which helps people to minimize the interest that they pay over the life of their loan. We're not just a broker who gets you a loan and sets and forgets. So we actually help our clients manage that throughout the course of their life.
Fantastic, Marius. And I guess it's probably starting to be or even more so busy time for you over the last couple of years, obviously, and then the last couple of weeks has probably made people rethink what they are doing with their mortgages for sure. So let's get into the topic. And I guess personally, I'm quite interested in this topic and the discussion items here as a person who's just bought their house in the last 12 years, still kind of learning the ins and outs and what it's going to mean with these interest rates that do rise. But I think it'd be good, Mark, if you can set the context for the discussion today and just help us understand why interest rates are increasing and the house prices are decreasing. And are there any risks that the households are facing or what those risks might be?
Thanks, Josh. Let me share screen. I'm not going to kill everyone with PowerPoint. I'm just going to basically do the scene setting and then we can get into the specifics around households. So hopefully that there is working.
Perfect.
So first, as I said, with Hey Coach, there's a QR code there. It's a free download, help you get started. And as we get into the details, you've got to request an obligation loan review through the app. So I'll put the QR codes up again at the end of the session. We also got a $2,000 investment portfolio for those that are downloading before 31 July. So I'm going to go through quickly more at a macro level, what's going on in the market and in the economy, and then how that's flowing through to the interest rate rises and potential impacts on property prices. So let me get this moving. So basically, the number one reason that interest rates are moving is because the spike in inflation. And so inflation is about, I guess, a decrease in our purchasing power because prices are increasing for a basket of goods and services. And inflation's been at a very low level, below the target range that the RBA had for a while, but it's really jumped beyond that. And so even though the RBA was indicating at one point that there'd be no change to the interest rate settings or the cash rate for the foreseeable future through to about 2024, because inflation has jumped so high, and there's a number of reasons why it's been jumping. Some of them are demand side, so demand from consumers such as ourselves. But others has been the demand side shocks as well. So energy market is a good example of that. But where inflation is at the moment, the RBA had to act, and so what they do in order to try and curb inflation is they start to move the cash rate, and the cash rate is what underlies how the banks borrow overnight to each other, but then how that ultimately flows on to interest rates in terms of savings rates, mortgage interest rates, etc. And so if you look at the cash rate and the slide here, you'll see it's at historically very low levels. The average since 1990 has been about 5%. Pre-GFC, it was up to 7%. This is the cash rate. This is not the interest rate we were charged on our home loans. This is the underlying cash rate. So, on average, they put another 2% on that if you're looking at at your variable rate. But you can see it's still at a very low historic rate, even though there's been two big jumps. What we see as big jumps, 0.25 and 0.5%. But you'll see that there's a long way for the RBA to go to start to bring it back to historic norms. And so that's why you'll be hearing in the media and the banks and the economists start to think, oh, it might be going up another 2%, might go up another 3%. You can start to see in this graph where that would take you, and it'll still be, low in historic terms. But if you've just got a loan, probably start to feel like it's getting pretty high for you based on where you are right now. So if we have a look at, I guess the other side of that is looking at property values. So property value growth has spiked again. I think depending on your market, it might have been 20-30% jump in property prices over the last 12-18 months. But you also see that there's been a spike in terms of the home loan value index. So this is how much people are borrowing to get into the market or to finance or their property purchases. So while there's been property price increases, I guess in lockstep with that, there's also been the value of people's home loans have been increased as well. So what we start to see at a high level across the economy is Australia, in terms of indebtedness of households, has been increasing steadily compared to other OECD countries. And if you're looking at the average there, Australia is on the upper end of the OECD countries in terms of how much debt or household debt we have relative to other countries. And that's, again, as we're seeing the asset values increase, the property prices increase, we've also been seeing households take out larger loans to finance that. So that sort of gives you an indication of how Australia's been diverging a bit from the average over a period of time.
Why is that, Mark?
Yeah, so there's a number of reasons, but the short answer is that Australia's had very cheap debt for a while, right? And so the ability to service that debt has been historically a lot easier than it has been in the past. And there's also supply side constraints around the areas that people want to live and the amount of housing stock that's available for people. So like, I know it's more complex than that depending on where you are in the country, but combination of, demand for the houses that are available in the areas that people want to live and cheap debt, bring the two of them together, and you just have to see it on an auction day. People are bidding each other up and competing for the properties that they want to get. and they're willing to take on larger loans in order to achieve that. So yeah, and and other countries have had different economic factors, whether it's more supply and housing stock, or more expensive debt, and therefore you're seeing variations there. But Australia, we love property, and if we can borrow to get into the properties that we want, we will do so.
Thanks for that, Mark.
So this is just a summary of what's happening. So if there's a 2% increase in interest rates from today, on average, you'll see that will mean 24% increase in your repayments on your monthly repayments or fortnightly repayments for that loan. So as interest rates increase, depending on the size of your loan, there's going to be it's going to start to take money out of the pockets of households, which is there to suppress demand, which is to try and get the inflation rates back down again. So repayment increases take money out of the economy, reduces demand for consumer goods, and then starts to try and ease pressure on inflation, which is what the RBA is trying to do. The other thing that happens is that when you increase interest rates, a 2% increase in interest rates would also reduce your borrowing capacity. So because the repayments are higher, you're going to be able to borrow less. So as an example, if you're looking to borrow $1 million today and a 2% increase in interest rates into the future, maybe you can only borrow around 800,000 in the future because of the repayments, and they're going to be higher. So starts to reduce how much money people have on auction day to be able to purchase property. And that what results in that potential reduction in property prices. But I think the other thing is, and you'll probably hear Mario say more, you don't want to panic here. Like if your property's just jumped by 30% and it's come back 10%, it's still well above the average in terms of valuation growth in property. But these are the things, this is how interest rates work. People are paying more for their loans, reducing the amount they can spend on consumption, reduce the amount that they can spend when they go to the next auction or they're looking at the next property purchase, and you start to see that flow through into property price declines as well. So just to finish off from me, just in terms of scene setting, there's a couple of risks for households. As I said, I think, you'll see there, we're still at a very historic low interest rates. So, there's still a long way to go in terms of where the interest rates might end. But, I guess the first, risk just to be conscious of as you're looking at your own household finances. First one is negative equity is, if you've recently purchased and you purchased on a very big LVR, so maybe you only put a 5% deposit down, there's a chance that your property is now worth less than your mortgage over time if interest rates keep increasing. And, that's only a risk if you're getting forced to sell, I guess. The important thing is to be able to maintain your repayments. Mario's about to talk more, it could also be difficult to refinance that if you're looking to try and switch banks, if you're in a negative equity situation. But typically it's a falling property price and or the fact that you've got a big loan on that property. But, it's definitely a position that you probably don't want to find yourself in, but it's one of those ones, again, you don't panic. You can get help on that and understanding what your next move might be if you find yourself in that situation. And probably the other one that's going to increase more and more, and the media will pick up on it a lot if they've already started, is this idea of mortgage stress. And really what that means is, getting yourself in a position that you're having trouble meeting your mortgage obligations or your repayments. As a combination of the rising interest rates, but it also could be a shock as well. So it could be rising interest rates and you have a loss of income, or you have emergency expenses and it's putting you under pressure. And because more and more of your income is going towards servicing your loan, you might find yourself less able to manage unexpected costs or a loss of income. And again, I think Marius used the right word. It's about mortgage management in this case, making sure you get support, make sure you're on the right type of loan, you've known your budget, your other obligations, and you've got a plan as to expect as interest rates increase. You've got a plan along the way as you go, not just today, but you've got a plan for what you're going to be doing in 2 years' time in a situation where interest rates could be as high as 2% higher than what they are today. So that's probably just a bit of scene setting for today's session. You can understand why the RBA is moving when you look at the inflation numbers. you can also look at the indebtedness of the Australian households and go, right, well, as interest rates increase, things like negative equity and mortgage stress may become more prevalent for certain households. And, I think that the idea of planning or managing for the future is where it's at, so that you don't find yourself in a crisis situation. You plan for that if you're out of income, unexpected expenses come up, you're not worried about your home or meeting your obligations. So I think that's probably a good start, Josh, just in terms of scene setting. And maybe you throw back to you. You've probably got a bunch of questions for Marius as well. So let me
before we do move on, Mark, I might just get you to jump back a couple of slides just to the data. One more, I think. Yeah, we just had a question in the chat, and I do encourage anybody that does have questions to use either the Q&A function in Zoom or the chat, and we'll try and work through them towards the end of the session. But Mark, this one's specific to the 2% interest rate increase. The question is it a 2% flat rise or a 2% increase of the current rate?
A 2% increase on the current rate.
Yeah, okay.
So it's not going to happen overnight, but I think we need to expect that they will go up. I think the RBA have been pretty clear that this is not going to be the last rate rise, right? So I think if just in keeping the maths easy for you, if you start to plan what would 2% extra on my current mortgage look like, and Marius will get into the detail. I think what would that look like when my fixed home loan ends? What would it look like as it rises over the next 12 months? What would happen if it happened over the next 6 months? And starting to understand, what's happening to my budget, what does it mean to my existing obligations, and keeping in mind that if it goes up by 2%, I might be getting, 20 to 25% increase in what I need to repay, and that could balloon out even more depending on your current loan and where you're going in the future, because not all loans are equal, and there's you might be on fixed, you might jump and balloon into a variable rate you never knew about, right? It's about more than any other time. Everyone's a genius when debt's cheap and markets are booming, but this is where you need to sort of plan ahead and thinking about what your future might look like. But yeah, I think whether it gets to 2%, 1%, 3%, if you start to plan around 2%, and that gives you a sort of a runway to sort of think about your finances, then you can you're in a much better position to think about what will happen if the RBA moves it even further. But it's a good place to start. I think keeps your maths reasonably simple when you're starting to think about your finances.
Yeah, and it's always that long-term thinking rather than reacting in what's in the news right now.
Absolutely, yeah.
So that was a really good overview, Mark, and that'll lead us nicely into Marius's expertise. So Marius, I guess just given what we've gone through now and what you know, how are the banks going to be reacting over these changes, and what's it going to mean to the householders?
Yeah, so with interest rates increasing, all the banks aren't actually changing their view on how they look at and assess. Your average person who comes in asking for a home loan, two of the most significant things that the banks have actually been bringing in over the last 3 to 4 years is a closer look at people's household expenses, and then also something called DTI, debt to income ratio. How much are you borrowing? How much of a multiple of your income are you borrowing? And so even if you can afford a loan of $800,000, if that loan is more than 7 times your gross income, they won't allow you to borrow. These are the types of stopgaps that the banks have brought in now, given that the rates are so low, because they know there's going to be a push up on interest rates, and now we're seeing it, as Mark said. But one of the most significant things is this: the banks have always, anytime they assess someone on their affordability, on what they can afford to borrow and repay back to the bank always assesses a higher interest rate than what you're actually receiving. So if today's interest rate is 2.5%, they would assess that traditionally at maybe 3.5%. But in the last couple of years, especially since the Royal Commission, that margin has increased significantly, and now it's about 3% above whatever your interest rate is. So if I go into a bank today and ask to borrow money, they'll look at my income and they'll assess how much I can borrow based on an interest rate of whatever it is today, which is around 2.5% plus a margin of 3%. So they'll assess me at 5.5%. If I can afford the loan at 5.5%, they'll give me the money. So that's really important to know, because we're talking about increasing interest rates. The banks have assessed that people can afford the mortgage after their household expenses, which everyone is drilling down on in detail now. So the banks know exactly what you're spending on a monthly basis. So they look at your income minus your household expenses, minus any other debt commitments you have. And if the remaining money you have from your income can afford a loan at 5.5%, you can have it, which is, I think, a little bit comforting, because then all we really need to do is just look at what we're spending our money on. And when we're reviewing expenditure, people's bank statements, and really breaking down what they're spending money on, there's a lot of things that we find and our clients say that they could quite easily cut back on. It's absolutely amazing. So I don't think there's too much need for panic. When you look at your discretionary spending, this, your Uber Eats, you're eating out, your Netflix, and all of a sudden you've got Stan and Amazon and Foxtel and these things.
I'm looking at my bank statements, Marius.
And it's amazing. And if you've got kids, all of a sudden the kids are signing up to all sorts of things. But we spend money quite easily when we don't have pressures, and then interest rates increase, and all of a sudden we have higher commitments. But it won't actually put too much pressure on, because a majority of spending at the moment is discretionary spending, which can quite easily be cut back. And it's just a change of behavior, really. So what are the banks doing? They're ensuring that they're assessing all loans at 3% above whatever the rate is that they're providing. They're putting in markers like DTI, debt to income ratio, so you're not borrowing more than 7 times your income. Sometimes it's 6 times. And they're also looking closely at everyone's household expenses. And if you can reduce your household expenditure, that will help you be able to borrow money as well. But even if you're spending below something called the housing expenditure measure, which is what the banks rely on, it's called, acronym is HEM. If you're spending, I know you're a single person, you're spending $1,200 a month to live. The banks believe that a single person without any children needs at least $1,480 per month to live. So they'll use that minimum, even though you're spending below that. And if you're spending more than that, well, then they'll use what you're actually spending in the assessment. So there's stopgaps there. I don't think it's really going to change anything moving forward, even when interest rates go up. We'll just see the assessment interest rate increase, which is where Mark mentioned before, your borrowing capacity decreases.
Okay, so that sounds quite clear. If we haven't yet purchased a home, if we're looking at that 3% above interest rates, if we're able to meet that, we should be in a strong position. And then it's about looking with a fine-tooth comb about where is our money going on a day-to-day basis.
Absolutely.
Just for those people that might not be in the market yet and are looking, you've mentioned lots of different acronyms, I guess, of how we need to understand our financial wellness. Any tools that you would suggest or strategies to get a handle on that?
Yeah, absolutely. Well, one of the things that definitely a budget tool, so a budget calculator, and you can generally download these off the bank's websites now. The government websites also have budget tools. Just a simple calculator. You go, and I know it takes time, but if you can print out 3 months of your bank statements.
Marius, I'll interrupt you. To make it easy, you can just download Hey Coach and it'll do it automatically for you.
Perfect. That's right.
Don't save yourself the pain.
Thank you, mate.
Yeah, or get the bank feeds in, off you go.
That's right, we do too. So through Hey Coach,
yeah.
When you link your bank accounts, it feeds through and actually breaks all of your expenses down.
Breaks it down, yeah. That's it.
Yeah, and you can see where you're actually spending money, and you'll be surprised. Your discretionary spending would be through the roof. You wouldn't realize, you go and buy a coffee, 2 coffees a day, and all of a sudden you're spending $9 a day just on coffee. In a month, in 20 days, you're spending $180. So There's little things like that you would be quite surprised where you're spending your money. But yeah, the Hey Coach app absolutely does it all for you, and one push of a button, right, Mark?
Yeah, at least
I can
maybe
verify.
2 buttons. Yeah, that's
it does integrate with your bank, and it does basically put your budget through and graph very nicely your savings, your mortgage repayments, all that sort of stuff. So for me, who's not super financially savvy, yeah, any sort of tool will help. Just a quick bit of clarification, Marius, just on the example you gave about the $1,400 per month for a single person.
Yes.
So that was referring to just discretionary spending, meaning after bills, repayments, insurance, or all inclusive?
No, all inclusive.
Yeah.
So your household expenses, all of your expenses, excluding commitments like credit cards, car loans, rent. So shopping, insurance, going getting your haircut, buying clothes to live, all of your general living expenses. So that is what's deducted from your income, and whatever income you have remaining is what the bank assesses your affordability on.
Fantastic. So let's talk strategies now, Marius. So what are the top tips for mortgage holders in this current environment of rising interest rates and property prices starting to decline?
Yeah, look, it's there's a couple of things. First of all, I would definitely be getting on a loan calculator and punching in an interest rate of 4 or 5% and seeing what the repayments would be at that rate, and setting your repayments at that rate from now. The wonderful thing is, if your mortgage payment is $1,500 per month, as an example, and you started paying $2,000 a month, then what you're doing, because you're paying more than the minimum, as interest rates increase, your repayment doesn't change. So you're well ahead of the curve, and you won't feel any pressures when interest rates do increase. The wonderful thing about paying more than the minimum as well, if you have a variable interest rate, that extra money that you're paying actually is available to you to redraw back out of the loan if ever you need it. So if you're trying to save $500 a month in a savings account, make it a payment on the loan instead, because you can always access it should you need it. As Mark was mentioning before, times of need, when something goes wrong, you don't have access to money. Well, this is the best way to build up some savings. The other thing then for existing mortgage holders is something we call chase the rate, which is what we do with all of our clients. So every year I recommend do a review, go back to your bank, renegotiate, and then also compare the market and refinance. One of the big things that the banks, all lenders do with interest rates now, it's been happening for 12 or 13 years, is the interest rate that it is offered in the marketplace is generally for new customers, whereas existing customers on the same product may actually have a higher interest rate than what's being advertised in the marketplace. So review your mortgage and your rates every year, renegotiate with the bank, and they will drop the rates. And as soon as you have that renegotiated rate, go and look at other lenders and refinance. Beautiful thing. You get a cheaper rate by refinancing. And also a lot of lenders giving something called cashbacks, where they pay people anywhere between $2,000 and $4,000 just to refinance to the new bank. When we factor those things out and we look at the average interest rate then over even a 2-year period, you're saving yourself in excess of 0.5% on the rate.
Yeah, fantastic, Marius. That seems like a no-brainer for everybody once a year.
Once a year, every year, review, renegotiate, and if you need to, refinance. But that's what we put in place with our clients at the moment. We do that automatically for everyone. So it's one of the toughest things to do as well, right? You have your mortgage, you have your interest rate, and it's just set and forget. And it's probably 2, 3, 4 years down the track before you think, oh, geez, let's have a look at it. And until it's blatantly obvious that your mortgage interest rate is higher than the market, it's when we do something about it. But we're 2 years down the track. Probably spent another $12,000, $15,000 more in interest than what you could have been had you renegotiated your rate at the very least, or even refinanced.
And Marius, there'll be people that have managed to fix really attractive rates for, say, a couple of years, but they'll come off that, over that journey.
Yeah.
So what happens when you come off your fixed rate? What does that roll into generally as a consumer?
Yeah, so you mentioned this before. We're all superstars when we're able to lock our clients into 2-year fixed terms at 1.89% in 2020. And we saw that the fixed rate slightly increasing last year as well. So towards the back half of this year, we're going to have our clients coming off their 2-year fixed rates. And what happens is a fixed term expires and you roll into the lender's variable rate. So variable rates are now, edging 3%. We're going to have people who have been locked in at 1.89 coming off at 3% later this year. And if we have any more interest rate rises, it's almost going to hurt. So already we're putting measures in place to get people prepared for that increase. And we're getting people to start paying more on their payment equal to where we think rates may be later this year. And we're doing that at 3.5%.
Yeah, good.
So Marius, with that in mind, and you spoke to it earlier where you're getting people to pay at that 5% mortgage so they stay ahead of the curve.
Yes.
Is it the same if, or essentially the same in principle, if they put all their extra money into an offset account? Is that essentially, is that taking the money or the interest away from that mortgage?
It's taking, now we're getting into product specifics and it can get a little bit complex because the term offset and people hear terms offset and redraw and what's better. But an offset account is really a savings account. So what's happening, you put all the money, all of your extra money into the offset account, this savings account, that saves the interest that you're charged on the loan, but your repayment is different from that. If your minimum payment is $1,500 per month, and you could have $200,000 sitting in an offset account, your minimum payment won't change. And as interest rates increase, so will your minimum payment. And you may start feeling it as a pinch, which is why I say, let's increase the minimum payment to make it $2,000. So as interest rates increase, you don't feel the pinch at all. And there's a lot of conjecture around offsets and redraw. And our advice changes regularly on this based on what the interest rates are for offset products compared to other variable products. Where I won't get into too much detail, but yeah, an offset account sometimes is more expensive to hold than a standard variable loan where you can just put all the money directly onto the loan. They have the same impact on the mortgage over the term of the loan.
Okay, thanks for that. There's a lot of considerations, absolutely, and so it's such a specialist area. I'm just going to pull a couple of questions out now. I think this one's for you, Marius, but does continually renewing loan pre-approvals with a mortgage broker negatively impact your credit rating?
Yes, it has. So every time someone you go and apply for something, you're doing a credit check, and every time you have an institution look at your credit file and actually through an application, it reduces your credit score. I'm not sure how many points it reduces your credit score by, but I've seen a credit score reduced by 15 points, another one reduced by 20 points just because a lender's looked at the file. And a good score is 700. So if you're doing 5 or 6 inquiries, it's going to reduce your score dramatically. My philosophy on pre-approvals is this: once you're approved, as long as your financial situation doesn't change, if you don't take on any additional debts, you don't decrease your income or change jobs, and if interest rates haven't increased, then there's no reason why the bank won't approve you again. They've already approved your character, your income, your credit history. They've said they'll give you the money as long as you find a property. So going and renewing the pre-approval or applying with other banks for pre-approval, I wouldn't do that at all. And if you're getting the right advice from the broker, they should be advising you on whether you can borrow, even if your pre-approval's expired. And then I would be looking at and reviewing the lenders once more prior to purchasing a property, or when you found a property, then look at all the lenders again to see who you'd much prefer to apply with.
Brilliant, thanks for that one.
That's okay.
And then another one is, are banks still looking for the 20% deposit to take out a loan, or is this changed or likely to change?
Yeah, 20% deposit. We flip it the other way and we say 80% lending, not borrowing no more than 80% of the value of the house. And historically, right up until the early 90s, banks would only lend you 80% of the value, and you would have to tip in 20% to the property. And then something called mortgage insurance came into play. So banks will let you borrow right up to 95% of the value of any property. You would only have to contribute 5% of the deposit and they'll lend you the rest. But then there's big fees involved called mortgage insurance that you would have to pay. And these are the sort of things that you talk with your broker about or with the bank about. And every bank, and I'll let you know now, every bank has a different mortgage insurance premium. So where you may walk into one bank and they tell you the mortgage insurance to borrow 90% of the value of the house is 10,000, another bank might say it's 8,000. So it's really, really important to be speaking to many banks or speaking to a broker who can tell you the strategy on how to even avoid paying mortgage insurance if there is a strategy available to you.
Yeah, and just for those who are not aware, so mortgage insurance is not protecting you because of your low deposit on the house. Mortgage insurance is there to protect the banks, and therefore they're taking out insurance which you pay for on their behalf. So so often we think insurance is about protecting us. No, this is about protecting the lender from you. Yeah,
that's right. Well, they're lending you a very high risk amount against the property. It's high risk for the bank. So in the event of a default, if they sell the property for less than what's owed, they'll go to the insurance company, make a claim, and get back the rest of their money. And then the insurance company will still chase the customer. So yeah, you pay a big premium once off to protect the bank in case you default. I mean, come on.
They've got a great business model, don't they?
Right. No, but it's there. But look, after the early 90s, when mortgage insurance came into play, it allowed people to then get into the property market with smaller deposits, which has been helpful, as we can see now with property prices.
Yeah. Really interesting question. I guess this person just came through the chat and they said they're entirely new to the Australian housing market. So they just wanted clarity. Is it not better to make larger payments against your principal than having the money sit there to redraw?
Okay, we're using terms again, but redraw is just a feature of a loan. So yes, it's always better to make large payments towards a mortgage. Home loans are very, very simple. It's like 1 + 1. And if you have a mortgage of $500,000 and you make a payment today of $2,000, then tomorrow your balance has reduced to $498,000. So it's reduced by the amount that you've paid. The bank calculates interest on the outstanding balance on a daily basis. So every time you make a payment, you're reducing the principal. And at the end of every month, the bank just looks at the daily balance, charges interest according to what the balance was each day, and then accrues it and charges it to you at the end of the month. So to answer that question, yes, every time you are better off to make payments to the principal because that's where all payments go. The term redraw talks about any money extra that you've paid into the loan above the minimum payments. That's always available for you to redraw out if you need it. It's always best not to, because by paying extra, you're reducing the term of the loan and also paying back less interest to the bank. But what I would always say is, rather than having money building up in a savings account, put it on the loan, knowing that you can always access it, because money on your loan saves you interest.
Yeah, absolutely. Mark, I'll just get you to provide a bit more detail around Hey Coach. A couple of people have asked what was the tool you mentioned before, so it'd be good to highlight that and maybe put the QR code up so people can actually have a play.
Yeah, absolutely. If there's a couple more questions we'll continue on, and then I'll throw it back up on the screen with the QR code. But Hey Coach, just quickly, it tracks your overall financial position. So your banking, so bank connections, does valuations on your home. It checks the latest rates in the market and looks at what you could save over the life of the loan, and enables you to connect to people like Marius to get loan reviews done. But there's other features in there as well. It tracks the value on your vehicle, super balances, investments, so all the areas of your finances, borrowing, cash flow, assets. But it does all those data connections for you, does your budgeting, things like that, so that it basically puts you on an informed decision when you're starting to make, really big decisions like, should I get a loan? Should I enter the property market? Should I refinance? Things like that. So in a couple of minutes time, I'll share screen and throw the QR codes back up.
Thanks, Mark. Next question is about superannuation. So the question is, in the news over the last week, they've said billions of dollars have been lost in people's super. Is that something we should be adjusting now, and how?
Yeah, so I'll probably answer that. So I guess superannuation is there as effectively compulsory savings to when you hit retirement age. And there's going to be a number of market cycles over the course of your career to the point where you hit retirement age. So it's starting to look at, I guess, one, you might have an attitude to risk, which is like, I really hate losing money. And therefore, when I start to see my money disappearing out of my super and, reducing in value, my natural reaction is I want to protect that and I want to be on something lower risk. But then there's also our capacity for risk, which is, even though I may not like losing money, I can't touch that money till I'm 65, and I've got at least another 20 years or 30 years to go before I need to access any of that money for living. So therefore, I'm going to see not just this market cycle, but I'm going to see a few more market cycles before my retirement age. And therefore, I've got a capacity to ride this market cycle out and then make sure that I'm still invested in growth assets for the next market cycle when things start to move back up again. And so I guess I'd say, have a look at your own situation and where you are in life. But if you start to move into a lower risk portfolio now, you'll be locking in your losses. If you maintain the course in a higher growth portfolio in your super, you'll be able to start to, I guess, you'll be buying in through your super contributions at a sort of a lower rate assets at the moment. And you'll start to see that you'll get the benefits when the market picks back up the other side again. So it's probably looking at how many market cycles you've got before retirement, whether you're going to need that money immediately in retirement. And if you're young, you're generally better off in a high growth portfolio and then having it there for the rest of your career and contributing regularly through your employer's super contributions. So yeah, if it was me, probably just leave as it is, but have a look at where you're at. If you're young, you can afford to be in a more aggressive portfolio. If you're older and you're starting to need that money as income, or you might need to pull down some of the capital as you transition to retirement, you might already need to have had in place moving to a lower risk portfolio. But you really need to see where you're at. Definitely don't knee-jerk reaction on particular market fluctuations. As an example, if you're in a really conservative portfolio, so basically everything's in cash or bonds, things like that, you may have missed all the growth after the last year. You may have missed the 20% jump in equities, and now you're starting to look at a 5% decline as it happened yesterday. And you're starting to see that, maybe, if I wasn't invested in the market, I would have missed the 20% growth for fear of losing 5%, on a market correction. So I think overall, super is a long-term play, and you're better off being in growth assets over the 40 years of your working career than sitting in cash. That's generally how it works.
Yeah, thanks for that overview, Mark. Final question. This one I think is for you, Marius. If you don't have a mortgage but need to downsize, is it still an okay time to sell and buy something smaller? So sell and buy in the same market, or will the decline in property prices stabilize or increase over the next 12 months or so?
Yeah. Look, I'm not a property expert, and but some of the economists talking about property prices reducing, and we're going to see property prices coming back. However, when we look at these markets historically, anytime we've had rising interest rates, we've had a dip in the market, which was generally due to sentiment, and then the markets bounce back. So if you're going to do it, I would generally say if you're going to sell and buying in the same market, it's going to balance itself out. If you're trying to sell in a down market, are you going to sit back and wait for property prices to increase? You're going to catch an upswing sometime. So as long as you do it in the same market, I think it's fair to say that it's going to balance itself out.
Thank you. All right, we're just about out of time. So Mark, where should people start if they want an informed next step?
Yeah, so So I guess number one, we're able to provide a no obligation home loan review. So, you know, as Mario said, it's about mortgage management as opposed to sort of reacting when you sort of need it or worrying about the future. Start to get a plan in place. You know, our belief is that mortgage brokers from a reputable firm like Loan Market is your best option. They've got an obligation to act in your best financial interests. They can look across the 60 odd lenders that are available and give you a strategy and a plan for what you need to do next. The easiest way to do that with Hey Coach, you can download the app. It's free. We'll provide the valuation on your home, which is something that the broker is going to need anyway. We'll be able to look at your overall income, expenses, etc. Make all that really easy so that when you talk to the broker, they've got informed information on your position and they're able to provide the right lending advice for you. So with Hey Coach, download the app, complete the quick setup, go to the property section, click on request loan review, and that connects you through to a broker who'll be able to make that assessment for you. And they're generally back to you within 24 hours. So made it super simple. As I said, they're a great firm. They're the ones I use as well. I think, you know, I've got no qualms at all and working with them as a great partner. But yeah, Hey Coach will make that easy for the broker as well. The last thing you want to do is end up on 10 weeks of back and forth trying to give the information the broker needs to be able to do the work for you. So the easiest way, use the QR code onto Hey Coach. Once you're in, go to the property section, do your property valuation and click on loan review, and the broker will take care of the work for you. And as I said, that's a free service and there's no obligation. So you're not going to be out of pocket.
Fantastic. Thanks for that, Mark. And thanks, Marius. I think there's so many takeaways from this session, and we will be making this recording public as well as the slides. But for me, I was really thinking about making sure that every year I go have a look at, get my loan reviewed again and start thinking about putting those repayments up to that 5% so that I don't put more stress on our lifestyle down the track as well. So thanks everybody for joining us for this session, and yeah, make sure you log into the Active and Thriving app this week to check out the resources.
Thank you.
Have a great day, everyone.
Thanks, Josh. Thanks.
Thank you. Bye-bye.
Bye, everyone.